battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42, almost 43 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Here we are, episode 142, rolling right through March, a couple weeks away from our big events in April. Get them on the calendar. Wealth Insights Forum Tour for the spring this year, April 17th in Oak Brook at Gibson Steakhouse, filling up quickly. We are already halfway full on that. Just sent out the email blast this week. Halfway full. Make sure you get your name on there or we will max out. We always fill up every single year. April 17th at Oak Brook. Make sure to get it on your calendar ASAP. We've got a week after that. We will be coming down to you in Houston at the Woodlands Trulux, and we'll be there. I think we've got about 30 more spots. So make sure you get on the calendar for April 24th in the Woodlands at Trulux. Can't wait to see you soon. Episode 142, where is the cut? We are coming up quickly here on a Fed meeting in just a couple of weeks. We are going to have some decisions from Jerome Powell, who says that it's time to cut interest rates. It's just a matter of when. I'm watching it very closely. At first, it seemed like to start the year, Powell was he's been wishy-washy the entire time he's been Fed chair. No question about that. Said that inflation was transitory, and he was dead wrong. I mean, we said for months and even 2 years almost that there was no way inflation would be transitory. We had printed tons of new dollars into the economy. Inflation was going to be here to stay. When you print new money into the economy, what happens is you deflate the value of each incremental dollar. And so it's sad to say, but what happens, especially for the lowest income group who the politicians say they want to help, is they just get completely crushed. Why? Because their stuff costs more and their dollar buys less stuff. That's really what it is. And so Powell, who said inflation was transitory, got it completely wrong. Now reversing and raising rates to the highest levels they've been in a long time really has not slowed down inflation. I actually don't think Powell is that responsible for the slowdown in inflation. I think we were going to get this anyways. Stuff was going up to the tune of 10% a year during COVID. Now the supply chains have normalized to a degree. We still got some problems. We've got a massive supply chain problem in housing still. But the reality is that Powell has not really been that effective at his job. Now he's saying he's going to cut rates, even though we're not exactly sure if it's going to be this month. Maybe it's going to be May. My bottom line here, and what I'm going to maybe point out here in a couple minutes in this argument, I'm going to make the argument in this episode this week, is the fact that Powell should cut rates. And in fact, he should have cut rates last year. He should not have gone as fast as he did to 5%, my opinion, a little over 5%. And I do think he needs to go to where the bond market is telling him. The bond market basically tells Powell where rates should be. He thinks that rates should be 5. Long-term treasuries are paying 4.25. That's called an inverted yield curve. So when a short-term bond pays more interest than a long-term bond, yield curve's inverted. It's not supposed to be that way. Short-term bond's supposed to be less interest. It's not. So what the market is telling you, what the bond market is saying is two things. Number one, rates are too high. They need to come down, and I do think they will. Although I think Powell is going to be late to the game. You saw today a jobs market report. Labor market is softening just slightly. But the way the labor market works, and this has been my concern as I've written about layoffs coming since April of last year, we've been well ahead of the layoffs curve. Remember, we try to tell you tomorrow's news today on the show. We try to show you what's coming down the pipeline here. And so just be aware of the fact employment today ticked up to 3.9%. Not the end of the world. I'm not a doom and gloomer by any stretch of the imagination, but I am putting a warning out there that if the Fed doesn't fix this problem with rates soon, it will be a problem. There is no question in my mind that if rates stay at the levels that they are right now, And Powell keeps the market scared. And that's really what's going on right now. It's not necessarily that rates are high. That is a problem. That's not the only problem. The bigger problem is that everybody's nervous. And so that fear that Powell has put into the market, into CEOs, into companies, into business owners, small businesses, has made them a little bit nervous, a little bit tighter with their money, could trigger a mass exodus, a mass round of layoffs. It's definitely possible. You're seeing this at some of the big companies. You saw Citibank laid off 20,000 people. That's massive. That's not just something to gloss over. You saw UPS laid off 12,000, and it's not drivers, by the way. It's middle management. So there's more of this coming, I think, the next couple months if we don't get interest rates under control. And I do think it may be too late to put the toothpaste back in the bottle. I think very likely that we have gone too far. We've stayed too high for too long and done not irreversible damage, but we have done some significant damage to growth. Now, it hasn't shown up in the economic data. Thankfully, we have not had massive declines in GDP. A lot of people thought we were going to get a recession. We argued against that. We said a recession would happen at some point, maybe next year, maybe the year after. Of course, we could have a recession at any point in time. But we continue to believe a recession has been pushed out thanks to all of the money on the sidelines. And so what it comes down to, just like any market and all of economics, is one thing, and that's supply and demand. If there's still demand, supply is coming down a little bit. People are still buying. They're still spending. There's still demand for equities. Prices will stay elevated. And that's what's happened with real estate. You've seen not a lot of supply, but still lots of demand. Even with 7%, 8% mortgages, people are reporting to us that they go to an open house on a house in the $300,000 to $500,000 range. That's important because it does depend what kind of a house you're looking to buy. But there's 40 people at the open house. Now, if you're getting into the $1 million+ range on your houses, or maybe you're looking at second homes, it is slowing down a little bit. I think the banks are being a little bit more cautious, a little bit tighter with lending standards than they were during COVID. So we are seeing a little bit of a slowdown on the ultra luxury space, on some of the vacation homes, but not really a doom and gloom scenario there either. So when we have high demand, we are working our way back to normalized supply levels. Prices stay elevated. Now, we are going to see, I think, a slowdown at some point here with middle America. And you're seeing the upper 1%, the upper 10% are pretty much okay. They don't have debt. So a lot of them don't even have mortgages. 40% of homeowners do not have a mortgage right now, which is pretty incredible. But it is that bottom tier or approaching the middle class, the true middle class, defined as maybe $60,000, $70,000, $80,000 in income, maybe $100,000, start pushing into upper middle class, pays most of the cost of inflation, and they are feeling the squeeze. There's no question about it. I talked to business owners that own restaurants and various establishments that are economically sensitive. They say they do see a slowdown. It's not to the 19 levels. It's not down to the 2020 or 2021 levels, but it's certainly not as high as it was in the 2023 numbers or 2022 numbers. We're seeing a little bit of a pullback. There's no question about it. It could still take a while, I think, for that to trickle into a full-blown recession. And I don't think, I could be wrong, but I don't think we are going to have, if we have a recession, an all-out abyss like we did in 08 and 09. I think we're going to look at a very small, short-lived recession for one reason. It's because there's so much money on the sidelines. Only 5% of economists now expect a Fed rate cut at this month's March meeting. A couple months ago, that number was 65%. You have to remember that most of the people projecting the economic numbers, or they're saying we're going to get a rate hike or a rate cut, really don't know what they're talking about. 2 months ago, 65% of economists said in March, no question about it, we're going to have a rate cut. Well, that number is now 5%. Most people don't think we're going to get a cut this month. Expectations are down because of a few hot inflation prints, because of what Powell said, stubborn rent prices, as we predicted. We think that rents could continue to rise for longer, even if we see a short-term temporary pullback. And I think this is one of the biggest problems facing the U.S. economy right now, is the fact that rents are so darn stubborn. a huge piece of CPI, which is the government tracked inflation number. You can argue if it's right or wrong, but that's the number they follow and produce. A huge piece of CPI, something in the range of 35 or 36%, is housing. Why? Because that's where most of people spend their money on a monthly basis. And housing numbers, rental numbers, are just not budging. We may see a small, slight pullback here or there, but landlords still have incredible costs to maintain properties. Their insurance costs are through the roof, taxes have gone up, and maintenance has gone up, and it's much more expensive to own a property. So they've had to raise rents. And I do think we're going to see upward pressure on rents, especially in major cities, because there's just not lots of supply. And a lot of people are just not getting approved for mortgages like they used to. Now, credit standards are very good, so that's a positive. And people are not like in 08 and 09 where they had 3 or 4 mortgages and second homes and no income verification. That's also slowing down the economy right now. One of the other things that people don't realize is that there's a supply issue too with housing, because builders have been slowed down since 08 and 09 to build homes. There's so much regulation. There's so many different new laws and rules that were put into place during the last crisis. Some of them were necessary, but in a large way, regulation in 08 and 09 just went too far. And because of that, it slowed down building. You can ask builders, it's harder to build a house today than it's ever been. Also, when the Fed raises interest rates, not only do they hurt home buyers, they also hurt home builders. Raising and cutting interest rates, like Brian Westbury at First Trust has said, is a blunt force instrument. It's not the ultimate solution. It's not a scalpel. And the Fed has been treating interest rates up a quarter point, down a quarter point, up 0.5%, down 0.5%, pretending that they have surgeon-like precision on how to run the economy. And that right there is the problem, the fact that they do have such an influence over our day-to-day lives. Again, I've told you this time and time again, as we get into this political season, don't get caught up in left versus right. Don't get caught up in Republican versus Democrat. They want us to hate each other. They want us at each other's throats, hating each other because we're a different party or different affiliation or tribal, and maybe we look different than somebody else. That's what really the government wants us to do, is to hate each other. Why? So we don't focus on the real problem. The real problem is the Federal Reserve. Okay. The reality of the situation is, and I just went back and looked at this again. This was Brian Westbury who did all this work and was on the cutting edge of helping us stay out of long-term bonds. We're actually going to have his at his firm. He's the chief economist of First Trust. First Trust CIO, Chief Investment Officer Dave McGarrell's joining us on an episode of Bullish in a couple weeks, and we'll release that in April. Don't miss that episode. Why? Because Brian's research, Dave's research at First Trust also showed that in 08 and 09, before we adopted this thing called loose monetary reserve or abundant monetary reserves, the federal government had less than $1 trillion of assets on its balance sheet. Today, that number's well over $9 trillion. Banks have had less assets on their balance sheets, but the Fed has more money on its balance sheet than ever. It used to have scarce reserves. Now it has what's called abundant reserves. And because of this, the government has more control over the money supply than they've ever had. It goes back to Communism 101, Marxism 101. It's actually a plank of Marxism, is the fact that you want to have a centralized control of money supply. Karl Marx knew this. He said the only way that you can possibly get communism to work in real life, or Marxism to work in real life, is to take control over people's money. Why? Because taxes aren't really that popular. If politicians had to come out and raise our taxes every year to pay for the stupidity that they pass, and I mean stupidity on both sides of the aisle, whether it's red or blue, they seem like they basically do the same things and spend and print a bunch of money on both sides of the aisle. If they had to raise our taxes to do that, they'd get booted out of office so fast you couldn't even blink. Well, the problem now is because we've adopted modern monetary theory, the idea that you can print money into oblivion, and it goes back to the idea that government creates wealth, not entrepreneurs, but government creates wealth. If you subscribe to that belief, then what's happened is you think that the government prints money and that capital is what spurs economic growth. Well, all it takes is a little bit of a history lesson to learn that that has never worked in all of human history. Look at the Argentinians. Now they're finally getting back to some sense of normalcy with Javier Milei. The inflation's out of control. They literally, to buy a sandwich, you have to bring a briefcase of cash because inflation's so high. So as Americans, we need to study what's happened in other places when they've adopted these horrible policies. I mean, my grandmother, for example, came out of Hungary in the middle of World War II, and the money was worthless. She remembers the kids playing in the streets with stacks and cash piles of worthless dollars because the inflation had gotten so out of control. That's what socialist and communist and Marxist countries do. When you subscribe to that belief that government creates wealth, you think that capital solves problems. Capital solves nothing unless you have entrepreneurs creating and innovating new solutions, coming up with ideas. It's ideas that spur economic growth, not capital alone. Obviously, you need capital, but it's the entrepreneur, it's people innovating, coming up with new technologies, cheaper ways to do things. Adam Smith, A Wealth of Nations, going all the way back to the most basic concepts of the division of labor, the fact that even this pen I'm holding here, and that was there's an essay called I Pencil talking about all the intricacies of making a pencil, and there's how many different suppliers that have to go in, from the trucks to the tire manufacturers to the gas station to the that transports the pens to the ink provider to the plastic provider to make the pen. There's a million different intricacies with the way this U.S. economy works. And my point with that is that it's way too broad, it's way too detailed, way too complex for any one government body to operate. And nobody can possibly, and this is the problem that communist China has gotten itself into now, nobody can possibly manage and navigate all those complexities. You need a market-based system to do that. What's happened with communist China is they took MMT, modern monetary theory, to an extreme. And basically what they did was they said, all right, government creates growth. Capital alone creates growth. All right, so what do we need to do to get more growth? We need to print more money. You print the money, what do you do with it? Well, you build these ghost cities that nobody lives in. If you go to China, there's thousands and maybe even millions of empty apartment units that have been built all over China just so they can print GDP growth. It doesn't matter if you're printing GDP growth, though, and those projects are worthless. And you saw this with Evergrande. And I don't think the problems are over with Evergrande. China is now cracking down even more on tech companies. And it was before, it was just companies like Alibaba with Jack Ma, who went missing for a while. Now it's even U.S. companies. They're basically trying to kick U.S. entrepreneurs out of China. And I think that is going to be the last blow. That's going to be the straw that breaks the camel's back. I believe, my opinion, in China, which is why we avoid their securities like the plague. I think you'd be out of your mind to be buying Chinese equities. It's just an absolute disaster. But what's happened here in the U.S. is we've adopted a lot of the same opinions, a lot of the same philosophy that the Chinese have proven doesn't work. And in fact, the only reason China is in the place it is today, the only reason they have any economic growth, and the only reason they have any wealth at all is thanks to us, thanks to our system. When we allowed them to become part of the favored nation status, when we allowed China to thrive off of the back of U.S. capitalism, at first it was friendly, at first it was fine, and they let our companies come in. They grew quickly. They went from $2,000 nominal GDP to $10,000, which is where they're at today, which is still abject poverty, quite frankly. For all the talk about how great China is, most people there live in squalor and absolute poverty when you compare it to the U.S. And for a couple of years, China allowed capitalism to thrive. President Xi has been much more against capitalism, especially American capitalism in China. And that crackdown has really started the past couple of years. It's just getting started. I really believe we have no idea if President Xi remains in power, which looks likely, how far he could go to kick capitalism out of China. And that is inflationary. One of the things that's happened under the past couple of years in the U.S. is we have done some onshoring. We brought manufacturing back to the U.S. We've taken it from China. The trade war with China has actually gutted them. It's helped us. But one of the problems is when you onshore and you bring manufacturing back to the U.S., you do have inflation. There are inflationary pressures there. So what CEOs are doing is they're looking at other emerging markets where they can build their factories. You saw Apple is largely diversifying out of China. They're going to India. I'm very bullish on India. Got a little bit careful on some of the companies over there, but I like companies in the U.S. that sell into the Indian market, for example. I'm very bullish on Latin America, quite frankly. I have a friend who does venture capital in Latin America, and he says it's just absolutely booming down there. The companies in the U.S. that can sell down there, Latin American companies. So there are other places CEOs can go, and that's why China is having problems. But again, in the short run, it leads to some inflationary pressures. The other thing that leads to inflationary pressures is what we did during COVID. Think about what's happened the past 4 years. First, in March of 2020, COVID struck. We shut down the economy. Millions of people were stayed home to do nothing, not work, and sit there and watch Netflix. Global trade plummeted. People are getting COVID checks to not go to work. And I understand at the time the panic. I understand the uncertainty. A lot of people died from COVID. I'm not making light of any of that. We all know somebody who is affected by it. But the reality of the economic situation was that a lot of people were receiving checks they did not need to receive. Everyone who used to travel, eat at restaurants, meet people at business conferences, instead stayed home smoking meats, riding or not riding their Peloton, using it as a clothes rack like ours is now at our house, maybe fixing their kitchen and bathrooms. So we changed the entire nature of the economy, which used to be very heavy on services, to very heavy on goods, and we were buying things. Well, that's changed. And now demand for goods is waning, demand for services coming back. But remember what we did during that interim period during COVID from 2020, 21, and even 2022. We pummeled the economy with 40 to 45% more dollars to buy stuff. And because of that, when the economy reopened, people had paid down their debt. People had become a little bit richer than they normally were, at least in the short term. They had cash in the bank. But the problem was they had cash that was quickly losing its value. If you had $100,000 in the bank in 2019, today that same $100,000 is worth only maybe 60,000 or maybe even 55,000. That's why we encourage you to stay in the equity market. And one of the big implications for what's gone on the past 4 years and all of inflation in general, despite what the Fed does, whether they act or not, whether they cut or raise, one of the big implications as investors is you have to be in the equity market. You have to have a claim on real assets. Why? Because companies don't take inflation lying down. What do? They raise their prices. If the cost of making the Big Mac goes up 40%, McDonald's does what to the price of the Big Mac for you? They raise your Big Mac 40%. That's just the reality. I saw the other day, Five Guys burgers and fries. Now for a meal, I think a drink, a burger, and a thing of fries is $25. There was a time I remember in 2015, 2016, somewhere in that zone, I worked for a company next to a really, really smart researcher, equity analyst and researcher, who said, Nick, I remember when burgers were 50 cents. And at that time, a burger was maybe $9 or $10. I thought that was a lot of money back then. He said, Nick, mark my words, you will see a $20 hamburger in your lifetime. I thought he was joking. I thought he was kidding. I didn't take him seriously. Here we are. And so the reality of printing money is we devalue, or we make our money buy less burgers. All along the way, though, one thing happened that we have not seen in U.S. history before. During record money printing, during record increased money supply and inflation, and all the doom and gloom things that happen, there were a couple people, and I would say really the top 1%, top 10%, the best S&P companies, the top 50, you could say S&P 500 companies were actually getting stronger. Why? Because they had products and services that were favorable during the pandemic. They had they were classified as essential. You saw companies like Amazon just skyrocket. Even Walmart skyrocketed. You saw companies like Apple and now Nvidia and Facebook and Apple just go through the roof and sell more products than ever. And what did they do with the products that they sold and the profits they made? They were nervous and they sat on that cash and let it grow, 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 grow. Same thing with wealthy individuals. And that's why I keep saying this economic boom, and it really is a boom. It may not feel like it every day. The GDP growth that's gone on a nominal basis before inflation has been so strong is because you do have so much stinking cash on the sidelines. There's still so much money out there. The top companies are now earning more on their cash in a lot of cases than most small and mid cap companies make in revenue. And this is really important to understand. I believe that the separation, the difference, the divergence the past 5 years between small cap, mid cap, and large cap has won by a massive majority. Small cap has not done much the past 5 years, neither has mid cap. It's been all large cap. That difference is going to continue. The compounding effect of having all that cash on your balance sheet, not really having a whole lot of debt you have to worry about, or if you do have debt, financed at 15-year or 20-year notes, is going to propel the top 50, you could even go top 100 companies in the S&P to heights we've never seen. And so one of the things you could see from an investment standpoint the next couple of years, despite what the Fed does or doesn't do, is the top 50 companies could continue seeing their prices rise astronomically. And it gets back into supply and demand. There's a lot of demand for these really good companies. All of the foreign money is chasing it. All the pension money is chasing maybe 10 stocks, 50 stocks. There's not that many really good companies out there. There's maybe 100, maybe 150, you could argue. And so there's not a lot of supply for good assets, but there's a lot of demand. You could see price to earnings ratios climb pretty dramatically. And I'm not saying we're going to get into a 1999 style bubble. I talked about this last week, and go back and watch that episode. Is this a bubble? I don't think this is a bubble. I really don't believe that. Usually when we have a bubble, I'll say it again. I said it last week. Nobody sees it coming. I don't think this is a bubble. If you compare today's price earnings ratios on the top 50 companies versus where they were 5 years ago, they're slightly higher. Sometimes they're lower. On average, they're a little bit higher than they were 5 years ago, but not radically higher. And we're trading the S&P today at about 20 times forward earnings. It's about where we were 5 years ago, maybe 19 times or 18 and a half times. But I think companies have become more valuable because there's just not that many good companies out there with these massive stockpiles of cash. And because of that, you could see S&P multiples go from 20 to 21 to 22 to 23. That would only happen, though, if the Fed starts cutting rates. And I think that's why they've been so cautious. That's why they've been worried, is they want to send a message to investors into Wall Street, and they're trying to avoid that massive frenzy we had in 2021. We had companies in 2021, as you'll recall, that traded for 200 times earnings. We had meme stocks going for astronomical levels because for some reason people thought we were going to have 0% interest rates forever. If you followed us this entire time now through COVID and all the interest rate hikes, we told you, you weren't surprised. And we said, hey, rates are 0%. They've got one place to go, and that's probably up. When rates go up, what happened to bond prices? What happened to long-term asset prices? They go down. And so I put an article together in the summer of 2021 that said too much, too fast. We're going to have a correction. Now, I don't think we're in a bubble today. So let me be very clear. I don't think we're going to be in this massive all-out bubble and a pop or anything like that. But I do think stocks are fairly valued. And I'll say something very similar to what I said in the summer of 2021. We're approaching the territory where earnings really would have to catch up, or the market is going to correct down. Don't be alarmed by this. After the Fed meeting on, I think it's March 20th and 21st, and then another one in May, it is very likely we have a pullback. We could see stocks go down 10%. We could see them go down 15%. It is going to feel different than before because you got a presidential election cycle coming up. And one side is going to say, oh, it's the other side's fault. And the other side is going to say, no, it's the other guy's fault. None of that's true. The stocks are just taking a breather. So one of the best things you can do in a correction is don't listen to the media, because what the media does is they take facts and then they put spin on it. The facts are the facts, okay? And there's nothing we can do if the stock market goes down a little bit or if GDP contracts or whatever happens. Maybe there's a hotter than expected inflation report, whatever it is. The facts are the facts. Nothing we can do about it. But what we can do is control the narrative that's attached to those facts. This is the narrative I'm going to give you today. I want to repeat what I said last week. A correction is a normal part of owning equities. We get corrections all the time. We're at least going to have one this year at some point. We usually get one big one. We get maybe 2 or 3 small ones. You know, those days where we go down 2% in a day and it's really scary. We're going to have plenty of those this year. It's part of owning equities. Ignore the media doom and gloom narrative, though, that says this time it's different. My urge to you is to remember it's not different. It's part of the process upward. I'm not saying that stocks are cheap today like they were in October of last year. I wrote an article, Bye Bye Baby. I did a show, Bye Bye Baby. I said, buy as much as you can. S&P was 4,200 points. Then it went to 4,400 points. I said, buy again. And I'm not saying that today. I'm not saying the S&P is radically cheap, but it's certainly not radically overvalued. We could enter overvalued territory, which is what the Fed's trying to avoid. And then I'll tell you the truth. I'll tell you, I think stocks are a little bit pricey. We're not at that point today. So just stay the course. Don't be alarmed. Don't panic when you see a correction come. Don't be surprised by it. I'm warning you now. I'm telling you, be prepared mentally. It's coming. And then what you do is you buy some more, you rebalance. Maybe you've had your eye on a couple of stocks that have gone way up this year and you've been wanting to buy. That's your buying opportunity. So stay invested. Don't panic. Our opinion now is that the Fed is only going to cut rates materially after some serious labor market pain. That is the only thing, I believe, my opinion, that's going to make the Fed slow down. They're going to wait until there's serious problems with jobs and mass layoffs. And one of the problems with layoffs is they are sort of a leading indicator in a way, not completely leading, but there is a leading factor to layoffs in the sense that when people lose their jobs, they spend less. That's just the reality. And we're not rooting for layoffs, of course. We think they're awful. It's management's fault. Of course, we agree on that. But all that being said, the Fed is not likely to cut rates substantially. Remember when they cut, they typically go down like an elevator. They go up like stairs. They go down like an elevator quickly. When that happens, when you start seeing mass layoffs, there is going to be a GDP contraction at some point. So layoffs are not really good for the economy. And so if we start to see layoffs tick up past 4% and then 4.5% and then 5%, just be prepared. There probably is a recession not too far along the way. I think it's a lot further out than people realize. We're monitoring it very quickly. But the bigger government gets, the more it crushes the little guy and entrepreneurs. Exactly the opposite of what's promised by politicians. The bottom 10% always pays the price for ridiculous print and spend policy. In other words, you've heard it before, there ain't no such thing as a free lunch. There's always a cost, hidden or explicit, that exists with bad monetary policy. We have experienced bad monetary policy the past few years. As such, I do think we are due for a correction at some point. Unemployment will spike, demand will weaken, a recession will occur. But the problem is knowing when that is. And what you could accidentally do by hearing my message or hearing some of the people out there who are true doom and gloomers. I'm not a doom and gloomer. I think the stock market's going to be just fine in the long run. I think the economy is going to do really well. I'm just telling you, be prepared for this mentally. One of the mistakes you could make is try and go to cash right now with the idea that you're going to time the market. You're going to try and somehow figure out when stocks are going to go down. And like the famous mutual fund manager Peter Lynch once said, more money has been lost preparing for corrections than in the actual correction itself. So if you get out and you time it perfectly on the way out, the problem is you've got to be right twice and know when to get back in. My experience, our team's experience, very hard to do that. It's very hard to be right twice and know when to get back in. And if you miss a couple of those big upswing days, the market goes down and then it recovers a couple of weeks later, and you miss that, you are going to buy in at higher prices than where you sold. Don't do that. Don't make that mistake. It's not really a fun answer to hear. It's not what you probably want to hear. But the reality is just stay the course. Don't panic. And you are going to see your stocks decline in the short run. There's no question about it before we ultimately go back up. In fact, there has never been a time in U.S. history where stocks have gone down where they don't go back up shortly thereafter. So stay the course, stay on your plan. I keep trying to encourage you to do this. Stocks are a leading indicator of what's to come. So by the time we're in the middle of a recession, news is already out there. It's already priced in. We could be in the midst of a recession like we were in 08 and 09 or in 2020 during COVID. Remember, economy got locked down overnight. We ended 2020 up 20% on the stock market. You go, Nick, how is that possible? Well, it's possible because stocks are a forward-looking indicator of what's to come. Everybody knew the economy was coming back at some point. And if you sold out and you panicked during the lows of 2020, man, you missed out on one of the best runs that we've had in history. So just remember, stocks price in the bad news ahead of time, and they recover before the good news is released. No one has a crystal ball, but we think there's plenty of room left to run before a recession happens. Because of that, the stock market could continue making new highs for a few years before becoming a bubble. Again, I think we're a long way away from a bubble. A lot of people agree with me. Our advice is to stay the course through the entire cycle, and just remember, stocks go up more than they go down. There has never been a time in history, a 10-year rolling time frame. Pick any 10-year time frame ever in 200 years of market history. There's never been a single one where stocks don't produce a positive return. So what I want you to do is be on a goals-based plan. Don't be on a risk-based plan. Be on a goals-based plan. A goals-based plan says, yes, we know that you're worried about the markets. Yes, we know we have to have reserves. Yes, we know that there are things coming up. But goals-based planning takes a look at what you need. Maybe you're retired and you need 3 to 5 years of living expenses. Okay, great. Set that aside, put that in cash, money market, treasuries, let it get 3 to 5% in interest. Perfect. But every other dollar allocated that you don't need coming up in a short amount of time takes every other dollar invests in great companies. And why would you sell those companies if you don't need the cash? You hold them for the long run. You buy a little bit more when times get tough. And when you're buying during those corrections, you're making all the money. You're making most of your return in those down years, those down months, those down days, even though it felt bad at the time. So stay on your plan. Don't be alarmed if we see a correction. I think stocks are going to be just fine in the long run, and I would use it as an opportunity to buy more. Thank you for being with us. Episode 142. We'll see you next week, episode 143. And hopefully we'll see you at our Wealth Insights Forum at Gibson's in Oak Brook on April 17th and at the Trulux Woodlands, Trulux on April 24th. Thanks for being here. We'll see you next time.